Good morning, Mark. And today we're going to be talking about goal-based investing. And I know most of you out there are thinking, what the heck is that?
Goals-based investing, Ben. I think as the name suggests, it's investing with the end goal in mind. Coming to think of it, it's probably not that obvious, right?
Hello and welcome to Real Financial Planning with Ben and Mark, two lifestyle financial planners who are passionate about helping people understand their money and what it can do for them.
So, Mark, kind of traditionally, someone wants to invest their money. They come to a financial advisor and say, hey, I want to invest some money. And they will look through some papers and things, and they will come up with the best investment for this money. What's the wrong in this scenario?
Yeah, Ben, so I think it's, there's nothing really wrong with it. It's just that, what are you benchmarking that investment against? What is the purpose of the investment? We're not just going to do a risk profile and say, okay, you're moderate, go into a moderate fund and expect moderate results. I think the topic of goals-based investing is saying, okay, so you've got this pot of money. What do you want it to do for you? What are you trying to align it to? So maybe digging deeper, asking more questions, trying to figure out what the purpose of the money is for. So, as an example, I want to use this money to fund my children's education, university education. So now we've got a goal, we've got a time frame, which then we can work out and say, okay, so if we've got this pot of money, and this is how long it's going to be invested for, and this is what it needs to grow to, we can figure out where it should be, what the best place is for it.
So what you're saying, Mark, is that traditionally you would maybe fill out that risk questionnaire, and I might be really conservative because I'm just worried about what's happening. I don't want to lose my money. And so I fill out this questionnaire and it comes out super conservative. So you're going to put my money into maybe some money market fund, for example. Meanwhile, my child has just been born yesterday. So we've got 20-year time period or 18 years until they go to university. So the problem with that is my money is not actually going to really grow in that time frame.
Yeah, so twofold there. I think if we take a step back, so you've come out as conservative. You may have a big enough pot of money that it can be invested in money market for the next 18 years and it will be sufficient. I think the important thing is to say, okay, this is the goal. What is the goal going to cost? This is my starting point. This is how much I've got. So what does this money actually have to grow by in order for me to get from A to B? And then we have a risk discussion. So it kind of flips it on its head, but it's the risk is the risk that you need to take in order to achieve what you've said you want, given with what you're starting. And then it's up to you to say, I want to be conservative, more conservative, which means you're going to have to do other things in order to achieve that goal.
Yeah, that's good, Mark. So what you're saying is it's more about understanding what the money is for. It's about the time frame, the risk that's involved, so that we can then plan and calculate a very accurate picture of how much and how long you need to be investing for. So let's say, Mark, for example, I just come in with this R1 million and I just say, just give me the best returns.
Yeah. So we're not probably the planner for you. The best return would be based on what it is that you're trying to achieve. You got R1 million and you want to buy a 10 million rand house in 2 years. Well, the best return is probably going to be somewhere in crypto, right? It's nothing that we can do for you, but it's not that simple. It's not standing around the Brian saying, yes, I've got this really great Alan Gray investment. Alan Gray is an asset manager, firstly, there are underlying things within them, but it's what's the best thing for you is not necessarily the best thing for me.
Yeah, no, that's very true, Mark. And especially again, the key thing is when you understand what the person's goal is that you can help them to achieve it. Like imagine now going back to your example of this saving for education. What if when the child came to university and there wasn't enough money there, or there was a dip in the market and all of a sudden there's no money there to pay for this? So the whole reason for this investment is all null and void, really, because you still have to pay for it yourself.
Yeah, so in that scenario, I think maybe something that we're missing is we align in goals-based investing. The risk is sort of dictated by how much you've got to start and what you're trying to achieve. So you as the investor know from the beginning why you're invested in this sort of asset allocation, which will deliver this range of returns, and you're comfortable with being invested there. So the potential ups and downs, but maybe something else, not just necessarily in goal-based investing, is that it's an ongoing process. So what we start with on day one is not necessarily how it's going to end. In between that, we would have to assess it and say what's going on. Are the markets up? Are the markets down? What are the likelihood of you needing to draw on this money earlier? And sort of guide and assist in that conversation as well.
Yeah. And I think also when you're looking at the goal-based investing, I mean, obviously looking at it on its own, but also when you look at it in your total life. And so if you were looking at your whole life planning, you could have different investments, all accomplishing different goals and different tasks. So you could have one pot of money that's just there for your emergency fund. You could have a different pot of money that is there for education, another one for traveling, another one for that deposit for that house that you wanted in maybe, say, 5 years' time. And there's also retirement, right? These are all very different goals, or all requiring very different needs and requirements.
Yeah, I think that scenario is typically how a lot of our financial plans go. There's a whole bunch of different goals, needs, plans in place, almost like mini plans within the bigger plan. And each one of those investments would have a completely different investment strategy based on the need. So like the emergency fund, that probably would be in a very low risk fund because there's a high probability that you'll need to access it in a short period of time. The retirement fund should, depending on the age, we would be invested in, say, potentially something slightly more aggressive because there's a long duration given the outcome that you're looking for. So it's not a one size fits all. Put all your money here because it's going to give you this. Goals-based investing kind of breaks it up into different pots based on different goals and things that you're trying to achieve, which will then dictate the return and the associated risk.
Yeah. So in conclusion, Mark, we're saying is that the first and most important thing is understanding what are you trying to achieve? What is the goal that you want? Then we can see when is the time frame, and then we can calculate and then help you track towards those goals to make sure that you accomplish them. And then all these little goals together will make up the bigger life plan of yours so that you're constantly hitting your goals and achieving and living the best life that you want.
100%, Ben. That's exactly it.